Can a UTMA account affect financial aid? Are you curious about how a Uniform Transfers to Minors Act account might impact your child's chances of receiving financial aid for college? Let's break it down in simple terms. A UTMA account is a custodial account set up for a minor. The assets in this account are held in the child's name but managed by a custodian, typically a parent or guardian, until the child reaches adulthood. When it comes to financial aid, things get interesting. The free application for federal student aid, often referred to as FAFSA, treats the assets in a UTMA account as the student's assets. This is a key point because student assets are assessed at a much higher rate than parental assets. Specifically, FAFSA considers student assets at a rate of 20%. To put this into perspective, if there are $10,000 in a UTMA account, $2,000 is expected to be contributed by the student toward college costs. This can significantly reduce the amount of need-based financial aid the student qualifies for. On the other hand, parental assets are assessed at a much lower rate of approximately 5.64%. So, that same $10,000 in a parent-owned account would only reduce financial aid eligibility by about $564. This difference can make a big impact on financial aid eligibility. If you are planning for your child's education, it might be wise to consider how these accounts fit into your overall strategy. Some families may even think about transferring UTMA assets into a 529 college savings plan. This type of account is treated as a parental asset on the FAFSA, which means it has a smaller impact on financial aid eligibility. However, keep in mind that transferring assets can have tax implications. If the investments in the UTMA account have appreciated, you may face capital gains taxes when moving those assets. This is an important factor to weigh in your decision-making process. From an estate planning perspective, remember that UTMA accounts transfer control of assets to the child when they reach adulthood. This might not align with what you want for managing those funds. If maintaining control over how and when funds are used for education is important to you, incorporating trusts or other savings vehicles into your estate plan could be beneficial. Families should assess their financial aid eligibility before deciding how to fund education expenses. If financial aid is a priority, minimizing assets in the student's name, like UTMA accounts, can help preserve aid eligibility. Consulting with an elder law or estate planning attorney can provide guidance on structuring education funding in a way that balances control, tax consequences, and financial aid considerations. Lastly, while UTMA accounts avoid probate, they transfer assets directly to the child, which may or may not align with your family's estate plan. Understanding these factors can help you make informed decisions about your child's education, funding, and overall estate planning.